Hello, we're here today to talk about a discretionary mutual fund and group purchasing program for the APAL and Pear Growers Association in Australia. We were kind enough to be invited to your June forum in Melbourne, where we had the opportunity to present this to a group of the growers present. This recording is designed to help those of you who were unable to attend, or those of you who were in attendance but just want a refresher on the opportunity. But let me introduce myself. My name is Justin Niven. I'm the Managing Director and owner of KJ Risk Group. We've been trading for about 8 years and we joined AUB Group in 2015. Prior to that, I worked at a large multinational insurance broker called Marsh. We're experts in discretionary mutual funds, which is really what we're here to talk about today. But of course, we also specialise in corporate and private insurance broking, workers' compensation and claims management. At our presentation in Melbourne, but unable to join us on this recording, was one of my clients, Doug Pearce, Chairman of Maffett Limited and a McDonald's licensee for over 25 years. Doug's a qualified lawyer and previously worked for Amy. McDonald's themselves are our biggest client. We manage 100% of their business risks in Australia and New Zealand through a discretionary mutual fund, which has been highly successful. Doug's role in the presentation was to give some real life examples of how these structures have actually helped some very large businesses to succeed. Also present in Melbourne, but unable to join us on this recording, was Warwick Renton Gibb. Warwick is the CEO of Viper, and many years ago he came to me with an opportunity, and the two of us created a mutual called VLF Limited. VLF Limited is a mutual owned by around 500 Virgin pilots, and they effectively self-insure each other for a risk called loss of license, which really means if something happens to them and they're unable to fly anymore, it gives them a lump sum of money to retrain and continue their life. So Warwick and I run this mutual right now, and again, Warwick, along with Doug, we're up here to give you, the growers, some real life practical examples of how these vehicles have really helped businesses. AB Phillips brought this opportunity to me a number of months ago, and we started talking about ways that we could help the APAL and Pear Growing Association of Australia, and the mutual concept came up. AB Phillips and KJ Risk Group will be working on this DMF feasibility study and project for you all. So if you see their name, please understand that they are a critical part of the process and a partner in what we're hoping to deliver to you all. Let's jump into discretionary mutual funds. First, let's talk about risk. The first step in identifying a risk treatment is to identify the risk itself. So we assess the risk. What is it? We then have 5 typical treatments for that risk. The 2 most obvious and easy ones to address are to accept or avoid. We either accept the risk for what it is and continue on operating, or we avoid the risk. That risk is too high for us. We will no longer do that thing which leads to that risk. Transfer. This is at its core what insurance is. You pay money to an insurer and that insurer accepts the risk from you. That risk is thus transferred from you to the insurer. Sharing risk. That is the core concept of a discretionary mutual fund. You as growers will come together and share each other's risk and reap the benefits of that. Mitigation refers to risk management. There is a risk. What can we do to mitigate that risk, to improve it, and thus improve our outcomes? Transfer, share, and mitigate are at the core of a discretionary mutual fund project. There will be a layer of risk which is ideal for you to share. There will be a layer of risk is ideal for you to transfer. For the risk that you either transfer or share, in particularly the risk you share, you want to mitigate it, you want to improve it, and thus you will improve your own outcomes. So if you create a pot of money to protect yourselves and ensure your own risk, and then you improve that risk, you'll profit from it. Discretionary mutual funds, or DMFs for short. At KJ, we incorporate DMFs as companies limited by guarantee. The legal owners of a DMF are its members. In this case, it would be you, the growers. So you would cumulatively pull your funds together in the DMF to share risk, as we spoke about on the previous slide. The DMF helps you to smooth cost for members. A board of directors is required to run the DMF, and there needs to be majority representation by actual members on the board, so active growers, growing members of the mutual. So on a board of 7, 4 active members would be required. The point here is that The mutual is both legally owned by and run by its members. This is an opportunity for you as a group to take ownership of your own risk in a very real sense. So risk ownership can be acknowledging and accepting a risk and managing it, but in this instance it also means you will own the company that manages your own risk. Key definitions associated with DMFs. DMF stands for Discretionary Mutual Fund. So we call the cover issued by the mutual discretionary cover. It is not insurance. The board has absolute discretion over claims payments. So if we think about it like this for you as a group, you as growers form a DMF, you create a board where you have majority representation and thus control the decisions. You collect an amount of money that you use to manage your own risk. And what this is really saying is you have complete control over how you use that money and how you pay claims and what you want to reward and incentivize. So there's a lot of power in this model for you as a group to break away from the structures that perhaps insurance places upon you and really decide for yourself how best you want to protect yourself and manage your risks. The second definition is an aggregate. We may have mentioned it in previous slides, but that's the pot of money that we're talking about that we collect every year to pay claims. We would have a margin in there, obviously, also to cover operating expenses. Surplus is something we would hope we have every year, and that's where your claims are less than your aggregate, the amount that you collect. And this simple graph explains the aggregate structure that we referred to on the previous slide. If you look at the light blue section, think about that as the pot of money that you put together each year. If we think about risk treatment, that's the sharing component. You're all sharing that risk together in your mutual. The green layer around the outside is what we call excess of loss insurance, or XOL insurance for short. That's the bit of risk that you don't want to keep. So again, if we think about the risk treatments, that's the transfer element. So we have a share and a transfer element to your risk. We will have claims incurred to a certain amount every year. Hopefully they're that low, which would lead to a surplus in the mutual. So this is a mutual structure, and you can see that in a year where you have a good claims outcome and your claims are not higher than your aggregate, you as a group will profit from it, you will make money. This is one of the most powerful concepts of DMFs and why it works for groups like McDonald's and for Viper. You get to capture a layer of your risk expense and retain it in a business that you own, and you get to profit from those outcomes. So if each of you think through to all of your insurance renewals and all of those years where you've paid premiums and you've had very low claims, you've never seen any of that money back. The insurer never gives you $1 of that money back. In this model, all of that blue layer you would keep as a group, and you would be able to share that back amongst the group in certain ways, which we'll touch on in a slide or two. So the ability to capture that layer of risk, manage it for yourself, and profit from it is incredibly powerful. The board of the mutual, the DMF, has discretion over how the surplus funds are used. They can be used in a number of different ways. Probably the best way to use them is to incentivize risk management. Doug provided an example of how McDonald's has reinvested millions of dollars back into the system to improve CCTV systems, to move from analog to digital, to having more cameras and capturing key risk areas. The key there is they had a public liability risk exposure that they wanted to manage. And when they have CCTV footage, they can see if the event actually happened. Did that person slip over? Obviously, if they didn't, that helps. And if they did, you can then use that as a risk management tool to say, well, how can we maintain our restaurants better? How can we make them a safer place for our customers and our staff? And what that creates is what we call a virtuous cycle of risk management. So if we think about it like this, the mutual makes a profit. It reinvests it into risk management, which improves the risk, and then that improved risk creates a greater profit. And so that virtuous cycle of risk management continuously improves the business risk and provides better and better outcomes over time. Surplus funds can be used to reduce contributions in future years, so to lower your cost. It can also be used to smooth cost, and that means offsetting price increases, because there may be years where you have a lot of claims as a group. The claims aren't necessarily always going to go down, but at least in a mutual structure, you can see the transparency and the honesty of it. They are your claims. In the good years, you profit. In the bad years, you don't, but at the end of the day, you're sharing your risk. It's your risk. The opportunity to profit doesn't exist without those years where the aggregate is actually expended as well. But as the McDonald's program has shown over time, there is no better model. The surplus funds can also be retained for financial security of the mutual, which is vital. That needs to be a strategy underpinning the management of it to build surplus funds up, or to put aside for other key projects. DMFs are very tax effective structures. All of these things are enshrined in various legislation in Australia. There are no grey areas here. Because mutuals or DMF protections are not insurance, no statutory charges apply. So in New South Wales, Tasmania, fire service levy, most other states, stamp duty. In New South Wales in particular, for every $1 of property premium, you can pay 45 cents in statutory charges on top of that. In the mutual contributions, for your mutual contributions, those taxes do not apply. So there are significant cost savings, even if you're paying the same dollar amount to protect yourself from the risk in terms of your premium or your contribution to the mutual. The first point, which I skipped over there, is all revenue received by the DMF is not taxable. That's a thing that comes back to what's called the principle of mutuality. Without boring you with the details, what it ostensibly means is you can't derive revenue from yourself. Because it's a mutual and you all cumulatively own it, the government does not view that as taxable revenue. So thinking ahead to a DMF for you as a group, one of your key risks is around EPS paneling. Anybody with a cold storage facility will have this paneling in their facilities, but you'll also be familiar with the cost increases that the insurance market has passed on in and around this risk in the last few years, in some instances 200 and 300%. You've also found your placements have been split, which means one insurer doesn't want to take it all. It's split across 4 different insurers. They really don't like it, in short. Hard to place risk can be ideal for DMFs. It gives you a chance to take control of your own risk and get out of that market cycle where insurers take a dislike to something and exit that market. As a group, you will have the scale to self-insure yourself in this space if you all get behind it. Scale is an absolutely vital concept for a mutual. They don't work if they're small. They work if they're big, because you're sharing risk over a greater number of people. There are benefits to all participants in the group, jumping on board. You don't necessarily have to have an EPS risk. I just mentioned that by way of an example of a key risk which many of you face. There is a lot to be gained just by buying together as a group. There are economies of scale that come from that. So regardless of the risk issues that you're facing, if you don't have EPS, this is still a very, very powerful model. Think back to some of the tax advantages that we mentioned, but also think back to that mutual structure where we highlighted the blue component, which is yours, which if there's a profit in that, you all keep as a group. None of that is achievable under a traditional insurance transaction. As I mentioned, you've got to have scale to make a mutual work. The other thing that also helps is having a geographic spread. And this illustration basically underlines that. You have a geographic spread. If everybody's on board and we can spread the risk across all these different states and regions, if you think about a storm or some other type of event that might hit one region, because you've got this spread of risk, because you're all over the lower part of the country, you've got a greater ability to avoid the impact of that. If we only had one region and that one region was hit by an event or a storm, obviously your price would be more volatile. So that's what I really mean when I say scale, in this case geographic spread, really helps a mutual to succeed. So we need to move into a feasibility study, which will put the meat on the bones of this concept and really give us a structure to move forward with. But off the top of our heads, initially, we think the lines that are likely to be mutualized are things like property liability and potentially crop. There are other lines of insurance that you'll purchase where there will be significant benefits to group purchasing for you having a single master policy that you all share. Things like management liability, motor vehicle, travel insurance, and cyber liability cover. Your management liability cover includes things like directors and officers protections, fidelity, statutory liability, and really importantly, employment practices liability cover. We can mutualize those if they're big enough. Otherwise, the fallback position is a group insurance placement. This is a model that has worked unbelievably well for McDonald's. So 100% of their licensees in Australia and New Zealand, corporation, all of their assets, everything they do is in a model like this. We mutualize the bits that make sense, and everything else we have a group placement where they all share the placement. You've got the combined power of the group and the group's premium, which enhances your outcomes with the insurer. But let's not forget workers' compensation. Oftentimes, this expense can be as big as the general insurance expense for most businesses. So it's certainly something not to be forgotten. We can't create a discretionary mutual fund in the workers' compensation space. It's not legal. However, KJ has a specialist workers' compensation business, SureRisk, that provides the following and many other services. We provide group purchasing. So again, the theme that's running through this presentation to aggregate your purchasing and benefit from those economies of scale. Negotiations with insurers in all states and technical claims management and advocacy. The point here again is that aggregating your spend can greatly benefit you. In WA, Tasmania and ACT, we as a broker can negotiate these premiums on your behalf. We can control the price. And certainly if you start aggregating your spend in those states in particular, because we can intermediate for you, we can significantly improve your outcomes, and the deals that you will individually have with the insurers will improve. So in summary, there are huge opportunities for you as a growing group. Firstly, the APAL DMF, an opportunity to take ownership of your risk in a very real way by creating a company that you as members own, and any profit that's derived in that company you keep. Think about the insurance transaction and those renewals where you've had no claims year on year on year. You've never seen a dollar of that back. This is a way for you to set up a vehicle to capture that value and to keep it for yourself. You can reinvest it in risk management and improve your risk and your outcomes, and never look back. General insurance group purchasing, again, economies of scale, a way for you to reap the benefits of your scale and to get stronger outcomes with insurers, lower prices. Same can be true for workers' compensation, again, group purchasing, but also an advocacy program to wrap around that and provide you with services and support should you have a workers' compensation claim, to also provide best practice risk management in this space. I'd just like to thank you all for listening. I'm very excited to work through this opportunity with you in the feasibility study, and I really look forward to your support and hope that you all want to participate in the feasibility study so we can see what kind of structures we can build for you. Thank you.